If you receive payments from third-party applications like Venmo, CashApp, Apple Pay, Google Pay, or PayPal, then you should be aware of some new IRS rules that will change how you report these types of payments on your taxes. So prior to the passing of the most recent tax bill, the IRS had already been cracking down on people and businesses who do not report the income they receive from these types of applications. They introduced new reporting requirements, which were set to affect millions of taxpayers because now all of a sudden, these payment applications were being forced to report your payment activity to the IRS. However, a lot of those rules have been repealed as part of the big beautiful bill passing, leaving many people wondering how exactly these payments will be reported on their taxes in the future or affect them at the end of the day. So in this video, I am going to clear all of this up for you and let you know the new rules and potential tax implications you need to know about as a licensed CPA that tax plans every day at mycpacoach.com. So if that sounds good to you, please like this video, comment your thoughts below, and let's go ahead and jump in. Okay, so for context, prior to the most recent tax bill passing, the IRS released key guidelines that required third-party payment applications to do the following. First, starting in 2024, they were required to report your payment activity to the IRS once your total payments exceeded $5,000. Then in 2025, that threshold was to be lowered to $2,500, then lowered again to $600 starting in 2026, which meant that if you receive payments in excess of these amounts through a third-party payment application like Apple Pay, CashApp, or Venmo, then those applications would be required to report those amounts to the IRS and issue a 1099-K form to you to also report those amounts when you go and file your taxes. Now, from the IRS's perspective, this was important because it allowed them to identify unreported income that should in fact be taxed. According to Section 61 of the Internal Revenue Code, all payments you receive are considered income from whatever source it was derived from, unless the tax code specifically excludes that item as income. And what they found was that there were many people and businesses who received payments through these types of platforms that were not reporting those payments properly as income, which meant that the IRS could not tax it. And that led to these guidelines being introduced as part of the American Rescue Plan Act in 2021. But this did not go over well and became a highly debated topic for a number of reasons. For example, for one, it created confusion between what personal transactions were versus business transactions. For instance, the IRS specifically states that money you receive from friends and family as a gift or repayment for a personal expense is not considered income. So a lot of people worried that these types of payments that are literally not taxable would be taxed to them as a part of this change. And for two, it also created more complexity, compliance costs, and administrative burdens for all parties involved. For example, millions of online sellers, gig workers, smaller businesses, and even casual sellers would have to figure out how to properly report these tax forms on their tax returns, which should not just account for the income they received from a transaction, but should also include expenses that they incurred to earn that income, which is pretty complex and arguably unnecessary for very small dollar amounts. Not to mention the fact that the IRS estimated that it would receive over 40 million of these new 1099-K forms, and the payment providers had to file all these forms with the IRS and send it to their clients who also had to file these same forms on their tax returns. All of this eventually led to new rules being passed as part of the big beautiful bill, which officially passed on July 4th of 2025 and is in effect for the 2025 tax year. So let's go ahead and go over the new changes. First, the bill only requires third-party payment applications to report your payment activity under two specific conditions. Number one, the total amount of transactions in your account must exceed $20,000. And number two, the total number of transactions must also exceed 200, which means that if you do not meet both of these conditions, the payment application itself is not required to file a 1099-K form with the IRS or send you one to file on your taxes. However, this does not mean that the payments you receive through these applications should not be reported as income when you go and file your tax returns. The IRS specifically states that no matter the amount of reported payments, If you receive payments from selling goods or services, you must report all of that income on your tax return. This includes payments from part-time, temporary, or side work, regardless of how you were paid and whether or not you received a tax document at the end of the year for that income. So for example, if you sell any item at a gain, like clothing, furniture, or a car, then technically that gain is considered taxable income. Or if you provide a service in exchange for payment, maybe as a freelancer, a barber, stylist, cleaner, handyman, plumber, babysitter, or any profession that receive payments through these types of applications, then those payments should still be reported on your taxes. The tax rules on what income is and how it is taxed have not changed. Only the rules that require payment applications to report these types of payments to the IRS have changed. In very simple terms, your payment provider is not going to be the one to tell the IRS how much money you are making unless you make over $20,000 and have over 200 transactions. But you are still required to report this income on your own tax return. And if you do not, the IRS can still audit you and assess additional taxes and penalties on any unreported amount of income. Now, I know there will be people who will try to use these new rules to avoid reporting their income through these applications, but please be aware that the IRS has many other ways to detect unreported income. And with the vast amount of tax incentives and deductions already available in the tax code, you really don't need to lie or cheat to avoid paying taxes. On this channel, I cover hundreds of different strategies and deductions that you can use to legally and ethically reduce your taxes to the smallest amount possible. So make sure you subscribe and check those videos out. Or if you need immediate assistance with reducing your taxes, just apply to work with my team today at mycpacoach.com.